Hi, this is Professor Joel Littman. I'm back with you, and I wanted to share with you a slide that we got from Bank of America's global research team. I'm not a fan of Wall Street research ever. I'd say 99.99% of the nonsense that comes out of Wall Street research is terrible and useless. But this one, you can give credit where credit's due. I like what they did. I like it so much that I didn't even want to repeat it. I just said, let me just use their slides, and it shows you why. It's a very important point. It shows you why we're not headed for a massive recession, if probably not any recession at all in 2024. It's now July of 2024. And the signals and the things that are showing us what's happened and how companies have adapted and changed this year, beginning of this year, to massively improve things. And it's actually from March, April, earlier. So let me show this slide from Bank of America. What you're looking at right here is the total high yield debt maturities that were due in 2024 when you were looking at it in March of 2023. So when you're looking at 2024, you said it appears like there's going to be well over $100 billion of debt due. And it's going to be tough to get refinanced because everything going on by the banks, commercial real estate's in trouble, and other areas are having some real issues, rolling recessions or whatever. I think autos are having some trouble too. And so the banks aren't going to be wanting to lend in 2024. That's what people are saying. And you're going to have all these companies with $100+ billion of debt mature, and they're not going to get out of it because if you look at, again, last year, looking forward, it looked like that spikes to over $300 billion in debt maturities. They're going to have to be paid down. Remember, when companies are making down these payments, that means they have no money for R&D, they have no money for innovation, they have no money for raises. In fact, if anything, they might have to fire people, they might have to sell off pieces of the business, which is what happens. And if you looked at what happened and it was looking like, was that would increase to 2026 of $400 billion in debt payments, holding, and then skyrocket to over $600 billion in 2028. So it's basically saying we just have this giant head wall we're going into, and then after that it tailors off, meaning it tails off into 29 and 30, and there's not a lot of debt due in the later years. But this big head wall of debt that was due is what was very scary, and that's a reason why so many people are saying a recession's coming, because when all this debt comes due, there won't be any money left for doing other things like hiring people or innovating or growing or buying businesses or whatever else, right? That was the issue. Here's what's amazing. What Bank of America showed was that by March of 2024, the amount of refinancing that had been done, refinancing meaning not paying down the debt, but pushing the debt down the road so that it's not due this year or next year, was absolutely fantastic. So the whole $100+ billion drops to something like 20 billion, which is nothing, right? And so there was a risk. And suddenly in 2024, you're saying, so there's really no default risk because the debt doesn't come due. And these are the high yield, right? High yield, the most risky debtors, most risky companies. And it says if the debt doesn't come due, they can't go bankrupt. You can't have bankruptcies if there's no debt due, right? Because all you got to do is make your interest payments, which the companies are healthy enough to do, right? Now, how much debt is due in 2025? Amazing that that's been pushed back to 2025, and that gives a full year plus for companies to be able to manage their balance sheets. Now, 2026, that starts getting back to some levels, and what's currently due in 2027 is even higher than it was a year ago, and what's due in 2028 is bad. So what we're looking at right here is that 2028 is a debt head wall of such magnitude that if that doesn't get kicked down the road, if that isn't pushed down the road, you are almost certain to have a massive recession because companies won't have any money for doing anything else other than just paying down their debts. The likelihood of defaults and bankruptcies skyrocket. That creates a ripple effect through the economy and through the stock market that would lead to a massive bear market. But that's 4 years away. The chances of that happening this year are next to nothing. And while the stock market is a forward-looking machine, it's saying, well, why don't companies just push that debt down further? Now, 2029 and 2030 also don't look that pretty if we make it through 2028. Oh, okay. And then after that, you've got lots of room. So what people are expecting is that by 2026 and 2027, even at the higher interest rate levels of 5% that we're looking at, companies will again refi and kick down that debt, whether you want to call it kicking it down the road, or sometimes the banks will call it extend and pretend, meaning, hey, we know you're going to pay us, But if the debt doesn't come due and they can keep refinancing it down the road and making their interest payments and whatever else, this can be done over and over again. And you'd argue that 27 and 28 are higher than they should be, and those should be pushed down the road. And companies are saying, hey, we got a couple of years to worry about that. We don't have to do that right now. But what it's really saying is because of the massive refinancing, that's how important this slide is, and I give credit to Bank of America's research team for doing this. I don't give a lot of credit to the big banks, but this is one of the areas where they did good work, is that this drop of 100 plus billion down to almost nothing this year, and the drop of 300 plus billion down to less than half of that for 2025, pretty much assures that we're not going to have widespread defaults or bankruptcies amongst publicly listed companies, right? I'm not talking about small mom and pop shops or Main Street. I think it's still tough with these rolling recessions, and if you're in commercial real estate and autos, there's still a lot of trouble. But we're looking at the broad market, the total stock market. We're saying so little chance of default, so few bankruptcies, low chance of recession. We might have a correction this year, but there's no way we're going to have a bear market like 2008, 2009. There's no way we're going to, because then the debt numbers looked horrible. We're not going to see something like 2000, 2001 where we had a massive credit debt seizure. Nothing like 1991, nothing like the 1970s, nothing like 1929, 1930s. It can't happen because the CFOs and the CEOs of corporate America, publicly listed companies, have done some amazing things to push the debt down to some manageable levels so that they can continue to fight under a higher interest rate environment, but a much lower debt service environment because of how they've refined. So anyway, that's what I wanted to cover today, this one slide in one day, and I hope you got a lot out of it. Subscribe, like if you want to see more. Thank you.